Okay, think about this. You've got these global rivalries heating up, supply chains looking, well, pretty fragile. Could one single American company really redraw the map for critical minerals? Could it shake up national security and maybe even your investment portfolio? Today, we're diving into a really fascinating case study, USA Rare Earth. Their whole value proposition, it seems, hinges on how much people believe in their big visual. Welcome to the deep dive. We cut through the noise, filter the overload, and try to give you those key insights, those surprising facts, so you can feel truly informed.
And today, yeah, we're taking that deep dive into USA Rare Earth Inc. The ticker is USR on the NASDAQ. As of yesterday, August 7th, 2025, the share price closed at $15.04. Now, it's really crucial to get this up front. This company, well, it doesn't have revenue coming in the door right now. Its valuation and what we'll be leaping into, it's built almost entirely on a strategic narrative, a story about national security, about building a domestic supply chain for these absolutely vital minerals.
Right. So our mission here is to really dig in, investigate USR's fundamental business, look at the management, the financials, try to get a handle on its intrinsic value. We're pulling from all the sources we could find to give you, hopefully, a comprehensive, balanced picture. We've split this into two parts to make it easier to follow. First up, we'll tackle the core business, the management team, and those financials. Then, in the second part, we'll shift gears to look at market sentiment, who owns the stock, the risks involved, and then wrap it all up with a conclusion. And just a quick heads up before we jump in, mark your calendars. USR is set to release its Q2 2025 results. That's happening after market close on Monday, August 11th, 2025. So definitely stay tuned because we plan to cover those earnings literally within minutes of them hitting the wire right here. Okay, perfect. Let's dive into Chapter 1, Business Understanding. This is where we unpack what USA Rare Earth, USR, is actually trying to do. They've got this, well, incredibly ambitious vision, mines to magnets. They're basically trying to build a fully vertically integrated all-American supply chain for rare earth elements. Specifically, these high-performance sintered neodymium iron boron magnets. People call them neomagnets. So yeah, it's not just digging stuff out of the ground, it's the whole shebang, controlling it all.
Exactly. And their whole strategy rests on 4 interconnected pillars. They need all 4 for this mines to magnets thing to work. The first one, and the one that's supposed to bring in money the soonest, their near-term driver, is magnet manufacturing. They're building this huge facility, like 310,000 square feet, down in Stillwater, Oklahoma. Commercial production, they're targeting the first half of 2026, starting at about 1,200 metric tons per year TPA. That's the capacity. But the plan is to scale that up, way up to 5,000 TPA. So yeah, that's the main initial source of revenue.
Okay, so Stillwater is where the rubber meets the road, generating that first bit of income. What about the other pieces needed to support that, the other pillars?
Right. Pillar number 2 is metal making. They want to bring the capability to actually make the rare earth metals here domestically. In the meantime, they've lined up some interim offtake deals with partners in the U.S. and South Korea. Then there's processing. They've got an R&D facility out in Wheat Ridge, Colorado. There, they're working on their own special ways to separate these elements, like something called continuous ion exchange. It's supposed to be more efficient. And they've already hit a pretty big technical milestone. They produced a sample of dysprosium oxide that was like 99.1% pure, which, sounds technical, but getting that kind of purity, that's absolutely critical for the high-strength magnets you need in EVs or defense tech. It means their stuff can actually compete.
And the long-term foundation.
Right.
Where are the actual rare earths coming from in the first place?
That's mining, pillar 4. Specifically, they control this deposit called Round Top Mountain out in West Texas. And look, this isn't just any old hole in the ground. It's described as unique, substantial. It has 15 of the 17 rare earths. And crucially, it includes valuable heavy rare earths, things like dysprosium and terbium. Those are often harder to find and really important for certain applications.
Got it. So just to be super clear for everyone listening, USR right now, pre-revenue, no sales yet. But the plan is for future revenue to come mainly from those sintered neomagnets, targeting defense, EVs, industrial uses, medical stuff, consumer electronics, high-tech sectors. And way down the line, maybe they could even sell other critical minerals from Round Top, like gallium or lithium.
That's the long-term potential, yeah. So USR is really positioning itself as a first mover, trying to create a fully integrated domestic supply chain for these magnets. That's kind of the key differentiator, You compare them to someone like MP Materials. MP runs the only active U.S. rare earth mine, Mountain Pass, and they've been working on integrating downstream. But USR, they're aiming for the whole value chain right from the get-go. True mine to magnet.
And the scale they're talking about. It's pretty striking. I mean, right now, they're a development company, maybe 30 employees or so. But that 5,000 TIPA magnet output planned for Stillwater, how big a deal is that for U.S. demand, really? Like, what impact could that actually have on, reducing the risk in our supply chain, tackling that huge dependence on China?
Well, 5,000 TPI. That would actually mean a significant chunk of current U.S. demand. It's not trivial. And their core value proposition, their whole pitch is exactly that. De-risking the U.S. supply chain for these critical materials, directly tackling America's, let's be honest, profound dependence on China. China controls, what, over 90% of the global magnet market?
Yeah.
Yeah, over 90%. So this isn't just a commercial play. It appeals directly to companies wanting supply security and, maybe more importantly, to national security interests. It's strategic.
And the wider industry trends, they seem to line up with this vision, don't they?
Oh, absolutely. The global market for rare earth elements, it's set for some serious growth. Projections are something like $12.4 billion in 2024, growing to over $37 billion by 2033. That's a compound annual growth rate of nearly 13%. 12.83%. And what's driving it? Everything from EVs, wind turbines for renewable energy, defense, high-tech gadgets. The demand picture looks pretty strong.
Okay, growing market, that's good. But the competition, China's just this behemoth in the space. You said 69% of mining, almost 90% of processing and refining.
Yeah.
That's dominance. Are there other Western players trying to compete?
There are, yeah. But USR's positioning, it's kind of interesting strategically. You've got MP Materials here in the US, as we mentioned. They're integrating downstream, but their deposit is mainly light rare earths. USR's round top deposit with those heavy rare earths, dysprosium, terbium, that's a key difference. Heavy rare earths, or HREs, they're crucial for high-temperature performance, like in EV motors or sophisticated defense systems. And China's stranglehold on separating those HREs is particularly tight. So USR isn't just another rare earth player. They're targeting a strategically vital piece of the puzzle.
And it definitely feels like the U.S. government sees this, too. They seem to be lending a hand.
Yeah.
We've seen things like the Defense Production Act used to support domestic rare earth companies, plus that 25% tariff on Chinese rare earth magnets kicking in from 2026. That directly helps domestic efforts like USR's, right?
Yeah, that regulatory environment is a huge tailwind, no doubt about it. But it also, it raises a critical point. USR's success seems really tied to continued government backing. You could almost argue their business model is less about pure commercial competition and more about aligning with U.S. industrial policy, national security goals. So what happens if there's a big shift, a sudden geopolitical thaw with China, or maybe a change in policy away from onshoring? That could seriously undermine their value proposition. It's a key risk.
So given all that complexity, what about just getting into this business? The barriers to entry must be massive.
Oh, they're formidable. Absolutely. First, you need huge amounts of capital, billions likely, spread over years before you see returns. Then there's the technical complexity. I mean, China has spent decades mastering the separation and refining. It's not easy stuff. You've got environmental hurdles, permitting, dealing with potential radioactive byproducts. That takes time and money. And then looming over it all is China's market power. They can influence global prices, potentially undercutting new entrants who don't have the same scale or state support.
Okay, wow. So against those hurdles, what are USR's specific advantages? What makes them think they can pull this off?
Well, first, that growing Made in America brand. It resonates especially with defense and government customers and aligns with the political climate. It's a powerful draw. But the real ace up their sleeve, their truly unique asset, is Round Top Mountain, that heavy, rare earth endowment. That's a fundamental differentiator. And think about switching costs. Usually a customer might switch suppliers easily, but here, for U.S. defense, for critical infrastructure, the real cost of not switching away from China is this huge geopolitical risk, this supply chain vulnerability. That creates this non-traditional, powerful incentive for customers to switch to a domestic supplier like USR.
All right, let's shift focus. Let's move to Chapter 2, Management Evaluation.
Okay.
Who's actually leading this charge? The CEO is Joshua Ballard. He took over in December 2024. Background as CFO, 20-plus years in finance, operations, private equity. He's also a CFA charter holder.
Yeah, and what's interesting here is that his background, that strong financial stewardship, capital raising experience, that's probably exactly what they need right now. For a company like USR, pre-revenue, needing lots of capital, having a financial architect at the helm makes a lot of sense for this phase. Strategic planning, funding, that's key. Now, you could ask, down the road, once Stillwater is supposed to be up and running, churning out magnets, will they need more operational manufacturing-focused expertise? Maybe. That's something to watch. They only went public via that SPAC merger in March 2025, so it's early days in terms of public track record. No major crises yet. But they did manage to secure nearly $50 million in that initial funding round.
One thing that seems apparent is the transparency. Mr. Ballard particularly seems very active in talking about the national security angle, framing the company's mission. That definitely helps build that Made in America brand and aligns with those policy goals we talked about. And importantly, we didn't find any red flags, any adverse ethical stuff about the current management team. Always good to see.
Okay, so capital allocation. As you'd expect, USR is deep in a capital consumption phase. Pretty much all the money is going into building the core business. Constructing Stillwater, developing Round Top, there's no M&A strategy right now. It's all about building it themselves, organically.
And given their pre-revenue, burning cash, I assume share buybacks, dividends, those are completely off the table.
Oh, absolutely. None expected for the foreseeable future. Forget about it. And metrics like return on invested capital, ROIC, well, it's negative right now, so it doesn't really tell you anything meaningful yet. The entire investment case rests on the belief that all this money being poured in today will generate a really high ROIC later once Stillwater is operational and selling those valuable magnets.
Which leads us nicely into Chapter 3, financial analysis.
Yeah.
Looking at USR's financials. Yeah, it's clear. At this stage, the balance sheet, market perception, that told you more than the income statement, right?
Yep. Exactly. So let's look at the numbers as of March 31st, 2025. Market cap was $1.42 billion. That's a big number, reflecting a lot of market optimism about the future, not current performance. Cash on hand, $23.35 million. Total assets were $77.08 million. But here's the critical part. Total liabilities were $97.33 million, which means they had negative total equity of negative $20.26 million.
And just to hammer it home, pre-revenue, first meaningful revenue, maybe $40 million, isn't expected until fiscal 2026.
Right. And this is why you have to be careful. You might see some figures floating around, like a positive trailing 12-month net income, $30.63, or positive earnings per share, 13.6, or even a PE ratio of like 113. But for a company like USR, these are mostly just accounting quirks from the SPAC merger. They absolutely do not reflect operational profitability. Honestly, they're potentially misleading vanity metrics if you don't understand the context.
So what's a better indicator of their current financial reality? Probably that negative free cash flow. Like negative $3.21 million in Q1 2025.
That's much more telling. Yeah, it clearly shows they're in investment mode, spending cash to build the business, not generating it yet.
Okay, so connect the dots for us. That negative shareholder equity, the 10 over $20 million.
Look, for a normal, established company, negative equity is a huge red flag, major warning sign. But for USR at this specific point in its life, coming out of a SPAC, it's kind of an expected consequence. The market is clearly looking past the accounting numbers on the balance sheet right now. They're focused on the potential, the story, the mineral rights, the strategic plan.
And that massive gap between the negative book value and that $1.42 billion market cap. This is basically the premium the market is putting on the future story, right? They're not valuing the current books. They're saying, we believe in where this could go, and we'll pay up for that potential today. The huge question for you listening is how long does that market patience last, especially before the cash runs low?
So how do you even try to value a company like this intrinsically? Well, the most suitable method is probably a discounted cash flow, or DCF, analysis. You project out future free cash flows and discount them back to today's value. Our educational model assumes a high growth period, say 2026 to 2030, as Stillwater ramps up. Then maybe moderating growth through 2035, kind of in line with those overall rare earth market growth rates, 8.6% to maybe 12.8%. And crucially, because there's so much risk and uncertainty here, execution risk. Market risk, you have to use a high discount rate. We use a range of 15% to 20%.
Okay, and running those numbers through the model, what did that give us for an estimated intrinsic value range?
Based on those assumptions, our estimated range for USR's intrinsic value comes out between $10 and $18 per share. And notice how wide that range is. That itself tells you about the level of uncertainty involved. It's definitely not a precise prediction, more like an estimate of potential value under certain scenarios.
All right, let's move into the second half, Chapter 4, market sentiment. How was the wider market feeling about USR? Well, analysts, the ones covering it, seem pretty positive. We're seeing a strong buy consensus from 3 analysts. Average 12-month price target is $16, with a range from $15 up to $17. Firms like Roth Capital, Canaccord Genuity, Cantor Fitzgerald, they've all started coverage with buy ratings.
Yeah, and just the general tone in the media seems pretty favorable too. Lots of focus on the strategic importance, that national security angle we keep coming back to. Recent news has helped too. They announced a joint development agreement with a company called ePropelled for drone magnets and a memorandum of understanding with Moog looking at data center cooling solutions. Those kinds of partnerships, they add credibility. They show tangible steps towards actually selling products.
And what about the technical picture? Any signals from the trading patterns?
While looking at short interest, as of mid-July 2025, it was moderate, around 6.1%. That means a relatively small percentage of the float is being bet against the stock. And the days to cover ratio was low, around 1, so not a heavily shorted stock right now.
Okay. And price momentum?
Pretty positive, actually. The stock's been trading well above its 50-day moving average, which was around $12.33, and also above its 200-day moving average, around $12.09. So from a purely technical standpoint, that reinforces a kind of bullish sentiment among traders recently. Suggests investors are feeling pretty good about the direction.
Okay, interesting. Now let's look inside the company. Chapter 5. Ownership structure. Who actually owns USR?
Institutional ownership, like big funds and investment firms, it's still relatively low, but it's definitely been growing. We're talking maybe 24 to 28 institutions holding about 18.5% of the company. But what's interesting is the trend. 19 institutions have been adding to their positions, while only 7 were cutting back. That suggests accumulation by the pros. Some of the bigger names holding shares are Harridan Circle Investments and Newton Management.
And what really jumps out, I think, is the insider ownership.
Yeah.
It's significant, right? Around 19%.
Yeah, about 19%, which translates to roughly $175 million worth of stock at the current price. That definitely suggests management's interests are strongly aligned with shareholders. They've got serious skin in the game. The largest individual shareholder is Mordechai Gutnick, holding about 14%. And importantly, the most recent insider transactions we saw were mostly related to that SPAC merger process, not insiders dumping shares on the open market in the last year. That's generally a good sign.
So overall, the ownership seems fairly concentrated.
It is relatively concentrated, yeah. The top 6 shareholders own about 52% of the company combined. If you break it down by type, insiders hold 19%, hedge funds have about 16%, and the general public holds the remaining 42%. That concentration can provide some stability, but it also means a smaller group has quite a bit of influence over the company's direction.
All right, let's pivot to the risks. Chapter 6, risk assessment. We can use a SWOT framework here. Strengths, weaknesses, opportunities, threats. Let's start with the strengths.
Okay, strengths. Number 1 has to be that strategic asset. Round Top Mountain. Rich in heavy rare earths, unique. That's huge. Number 2, their vision for vertical integration, that whole mines to magnet strategy. If they pull it off, it's powerful. 3, those favorable geopolitical and regulatory tailwinds in the U.S. government support is key. And 4, that first mover potential in building this fully domestic integrated supply chain.
Okay, pretty clear strengths. Now the weaknesses. These seem pretty significant too.
Yeah, they are. First, obviously, pre-revenue status. Everything is projection right now. Second, negative cash flow. Highly capital intensive. They need money, constantly, dependent on funding. Third, massive execution risk. Building these complex facilities on time, on budget, making them work efficiently, that's hard. And fourth, from a pure accounting view, that negative book value signals financial fragility.
Got it. What about opportunities? Where's the upside potential?
Well, the market itself is a huge opportunity. That massive growth in demand from EVs, wind power, electronics, it's a rising tide. The national security angle creates opportunities too. The Department of Defense, other agencies could become anchor customers, providing stable demand. Commercial customers are actively looking to diversify away from China. That creates a ready-made market demand for a reliable U.S. supplier. And there's always the potential for significant government funding, grants, loans, maybe guaranteed purchase agreements to help them build out.
Okay, and finally the threats. What could derail this whole plan?
Competition is a big one. China isn't going to just roll over. They have immense market power, control over pricing. They could flood the market. Other Western producers like MP Materials are also competitors vying for market share and potentially government support. There's technological risk. What if new electric motor designs come along that don't need rare earth magnets? That could shrink their market. And then macroeconomic factors. Inflation drives up the cost of building everything. Higher interest rates make borrowing more expensive and can hit the valuation.
And that geopolitical factor, the U.S.-China relationship, seems particularly critical here, doesn't it?
Absolutely. It's a total double-edged sword, like you hear people say. On one hand, those U.S. tariffs on Chinese magnets starting in 2026, that's a direct benefit, a tailwind for USR. But on the other hand, what if China retaliates? They've already shown they'll restrict exports of certain rare earths or the chemicals needed for processing or even the equipment. If they ramp that up, it could cause chaos in the market, extreme price swings, and potentially disrupt USR's ability to even build out their facilities or get needed supplies. It's a really high-stakes dependency.
Okay, let's try to pull all this together. Chapter 7, conclusion. Let's lay out the bull case first. Why invest in USR?
All right, the bull case essentially says USR is becoming a vital piece of America's industrial and national security future. They have a unique world-class asset in Round Top, especially those heavy rare earths. They're plugging into massive long-term demand growth from EVs and green tech. There's strong bipartisan political will in the U.S. to reduce dependency on China, creating a supportive environment. They have a clear roadmap to near-term production with the Stillwater facility. And management's interests are aligned with shareholders through significant ownership. It's basically an investment in building critical 21st century infrastructure in America.
Makes sense. Now, the bear case. Why might someone be hesitant or bet against them?
The bear case screams execution risk. It's immense. This is a hugely complex, expensive undertaking for a pre-revenue company. Their financial position is fragile. They're burning cash, need more capital, have negative equity on the books. Competition is fierce, not just from China's low-cost production, but also from other Western players like MP Materials, who might be further along in some aspects. And their entire strategic advantage is fundamentally tied to the current tense U.S.-China relationship. If that dynamic changes, if policies shift, their value proposition could evaporate, leaving them as just a high-cost producer trying to compete with a dominant incumbent. It's high reward, definitely, but undeniably high risk.
Okay, so summing up the valuation piece again.
Right, remember the discounted cash flow analysis is probably the best tool here, despite the uncertainties. Based on our educational models, assumptions, successful ramp-up, decent long-term growth, but applying that high 15–20% discount rate for all the risks we landed on, that estimated intrinsic value range of $10 to $18 per share.
So, our concluding outlook. With the share price at $15.04 as of yesterday, August 7th, it's sitting right in the middle of that estimated range.
Exactly. It suggests the market is currently pricing in, well, a fair degree of success for USR's plans. They're giving them credit for the potential, but they're also clearly acknowledging the significant risks involved, hence why it's not trading way above that range. What happens next? The company's ability to actually hit those timelines for the Stillwater facility, start production, start generating revenue, that's going to be the absolute key near-term catalyst. That will likely determine whether the stock moves towards the higher or lower end of that valuation range. It's really a story that's still unfolding.
So, here's a final thought for you to chew on.
Yeah.
As the world keeps wrestling for control over these critical resources, how much weight do you personally put on geopolitical independence when you're thinking about your long-term investment strategy?
And hey, if you found this deep dive useful, please do hit that like button and subscribe to Stock Analytics AI on YouTube. It really helps us out. Remember, members paying $4.99 a month get priority requests for deep dives on specific tickers. Plus, we're gearing up to cover all the S&P 500 stocks over the next few months, and members get exclusive priority access to that content. And if you just want a one-off deep dive on a stock you care about, you can always use the Super Thanks button to support the channel and make a request.
And just the necessary reminder, this analysis was generated by an AI system. It's purely for educational purposes. It is absolutely not financial advice. We strongly encourage you to do your own thorough research, or better yet, consult with a qualified financial advisor before making any investment decisions.